Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Alex Coffey, senior market strategist at Charles Schwab, as well as Joe Mazzola, head of trading and derivatives strategist at Charles Schwab. They join me to discuss the latest Schwab Trader Sentiment Survey, a quarterly study that explores the outlooks, expectations, and perspectives of traders at Schwab. It is great to have the both of you with us as always. Joe, I'm going to kick it off with you. What were some of the highlights that you saw from the survey for this past quarter?
Yeah, so as you mentioned, this is an attitudinal survey, right? So this is basically what traders say, what they're thinking right now, and we saw a dip. So traders are a little bit less bullish than they were before, maybe kind of teetering on. I wouldn't say bearish, but at least losing some of that bullish momentum. We saw a drop from 53% down to 46% being bullish. And the main reason that they're citing this is just inflation concerns. You got the CPI and the PPI report. You got to remember, Jill, this came out at the end of April, so we were kind of fresh off that hot data. And it kind of curbed their expectations for the Fed policy. It curbed expectations for whether or not we get any cuts. Now we're seeing expectations for maybe 1 to 2 cuts from our traders. And what I found really interesting about the report, and this is where maybe it's a trader versus an investor type of thing, is the traders say, look, even with those type of headwinds, we still feel good about what we can do. Maybe not what the economy can do, but what we can do. And I think a lot of that is based upon the fact that they're moving away from maybe some indexing, looking a little bit more at single stocks where they can generate some alpha from their own research.
Right. And Alex, let's take a look at how they're positioned within their portfolios, because it kind of is a little bit of a difference there in terms of how they're thinking, how they're feeling, and how they're actually positioned.
No doubt about it. And I think, Joe really hit the nail on the head, which is through sort of the education offering and the kind of advances that technology has made over the last, decade plus, individual self-directed retail investors are more confident and more put into a position to succeed now than ever before. And we're seeing that when we look at things like the Schwab Trading Activity Index, or STAX, and we've looked at that, countless times over the months, Jill, where this is actually combined with the sentiment survey that Joe's talking about is what are the traders telling us they're doing? The STAX is an assessment of what they've actually done with their trading activity and their portfolios. The most recent reading that we saw in April did, alongside that, increase in volatility, see a little bit of a dip in terms of the risk-taking sentiment in the month of April. But the area where the traders saw opportunity was those same stocks that they told us they liked in the survey, which is the AI-driven stocks. So while in the survey, and Joe could probably expand upon it even more, they talk about them feeling like they're expensive, but they're still bullish on them. And we see that today with NVIDIA's jump. Just because a stock's expensive doesn't mean it can't go up. But they bought names like NVIDIA, SMCI, the AMDs of the world, and those have been where the action has been in the market.
Yeah, and Joe, we can see that in the dispersion between the types of stocks that Alex is talking about relative to where the Dow is sitting right now as we're speaking at session lows. So they're being very discernible in terms of where they're putting capital to work.
Sure, and I'll take that a step further from what Alex said in terms of the behavior. If you go back to April, what happened was NVIDIA had pulled back 10%, AMD was down 20%, SMCI was down more than 20%. So we had dip buyers from clients, especially the trader clients, that were looking for opportunities where, they can still say it might be overbought and they can still say it's expensive. But when they do get those pullbacks, when they do get those opportunities, that's when they're taking advantage of them. That's what we saw from the behavior and what they did in April.
Yeah, and it'll be interesting, Alex, because NVIDIA announcing that 10-for-1 stock split, while the valuation remains the same, the perception that it's less capital intensive to own a share of NVIDIA, we've seen what happens historically with that, where the valuation can move higher just because the price is lower for investors to get involved. So I'm curious to see how that could potentially impact it once it splits.
Yeah, and look, as a champion of the retail investor and trader, I love the stock splits just simply because it makes it more accessible to a smaller investor. And it oftentimes, because of that increase in supply of shares, it can actually dampen that volatility a little bit. And so it'll be a lot more interesting, I think, to look at NVIDIA as potentially a $100 stock than the $1,000 stock that it is, of course. But absent NVIDIA today, Jill, to your point about today's market action, this could be a lot worse of a day for the S&P 500 or the Nasdaq had NVIDIA, not been up the 10% plus that it has been throughout the day. quietly as this market continues to take in news through the filter of bad news is good for the market, good news is bad for the market. Those stronger than expected PMIs that we got this morning, reinvigorating those fears of rates higher for longer, and we're really seeing that spiral, I think, unfold here intraday, despite Nvidia's blowout quarter once again.
Yeah, but Joe, what I find interesting, if you think about it, in the beginning of the year, the market was expecting 6 to 7 rate cuts. We didn't get it. I think the way the market's digesting earnings in 2024 relative to they were in 2023, we're seeing more of the market sitting at relative all-time highs, with the exception of today's action, where it's driven more on fundamentals than necessarily being dependent on the Fed. Because, by the way, at this point, should we get 3, 4, 5 rate cuts, instead of perhaps 0, 1, or 2, there's a bigger issue, because that's a signal there's something really wrong with the economy. So I think the fact that the market has moved the way it has based on fundamentals is somewhat encouraging relative to being, only focused on what's happening with the Fed.
I couldn't agree more, Joe, because if you think about what would be the backdrop for us to get 5 to 6 or 7 rate cuts as the market was expecting in November, December, I couldn't fathom that happening unless it was a severe downturn, or maybe some type of financial crisis within the banking system. That would be the catalyst for those cuts. So, I'm sure Alex would agree with this, and I know for sure that our fixed income strategy team agrees with this. We were never in that camp. We were maybe in the 2 to 3, potentially 4, if things really lined up correctly in terms of the inflation front, or disinflation is probably a better way to put it. But when you look at this market, it is trading off of fundamentals. And I will say this, though. It's been an interesting earnings season in that you've had a high 70s, low 80s earnings beat rate. But when you look at the 1%, or excuse me, the day of and the day after move for a lot of these stocks, actually they're down, believe it or not, relative to the S&P 500. So you're not getting that alpha from those stocks that are beating. What's generating the alpha is not the beat. It's the revenue, it's the guidance, and it's the look ahead for the rest of the year.
Right, but Alex, I feel as if investors are becoming more decisive when they're thinking about where they're going to allocate capital, right? Revenue is what matters, right? Whether it's an ARR or they're just increasing revenue, they want solid balance sheets or looking for governance. You're just not getting a pass because you're affiliated with a specific sector. Now, I get Nvidia is a special situation, right? I mean, because it has touch points in so many different areas of the market. But I think investors have earned the right to be more discernible in terms of where they're putting money to work, as they should be. We've learned during this valuation reset in 2021, 2022, the first half of 2023, that these things matter. Fundamentals do matter.
No doubt about it. And to kind of tie this and square this up with what you and Joe were just talking about with kind of the expectations for the economy and rate cuts, the market largely agreed too that, 3 rate cuts was the most likely scenario. It's just there was this fat tail about economic uncertainty and recession fears that dominated most of last year and coming into the beginning of this year. That's largely been cut off now. And the market, as well as traders who are surveyed within our Trade and Sentiment survey, largely agree. There's not this really large, overwhelming fear of recession that's present in the market right now, as GDP remains strong and inflation has taken kind of the helm as the primary risk factor. So in this potentially stronger growth environment with inflation, you have almost a reflationary market. And in that sense, where do you want to be? Where do you want to be invested? You want to be invested where companies are growing faster than money's potentially losing its value. So it makes a ton of sense, everything that you just said.
All right. Appreciate both of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.